Let's get to Kevin Green, who is our markets correspondent here, senior markets correspondent for what you're watching today. Kevin, very good morning to you.
You as well. I mean, obviously, we are seeing strength to start off today's session with around 70% of the stocks in the S&P 500 in the green. And it's pretty much all of the, it's a mixture of sectors, right? The risk-on sectors like communication services as well as information technology. But you're also seeing materials and even healthcare catching a little bit of a bid today, which is actually pretty decent. But if you're looking at the start of the morning and the levels that I'm kind of looking for, it's actually the upper end is 64.70. So we actually opened up pretty close to that range at 64.67 or so. It's going to be your first major area of potential resistance here in the market. And if we're able to break through that, then you're actually starting to talk about 6,500, which would be an aggressive move to the upside and really confirms the breakout of some really key technical levels here. To the downside, 64.35 is going to be your first area of support. And then if we see any further breakdown below that, 64.05. So Sam, once again, we've been able to kind of break through these levels. We are starting to see a stair-step approach when it comes to options positioning as well. We will have options expiration here this Friday, actually, that we will be mindful of, and we continue to see players kind of moving those short calls to the upside here if they're collaring a portfolio, which is bullish, and then moving up their put buys as well, trying to move up that collar. So that's exactly what we want to see in an environment like this, and hopefully we're able to maintain these gains, continue to move higher. And I think the market's also kind of pricing in that PPI may come in line with the street's expectations or even better. That would be just kind of the icing on the cake from the fundamental standpoint, giving the Fed another reason to be able to cut in September, which has obviously been a little bit of a bullish tailwind for the market here.
Okay, maybe further confirmation there, and no doubt could give markets another reason to march higher. I'm just wondering, those are the levels you're watching. What are you seeing with regards to the correlation between tech and utilities? Because I have to say, time and time again, many say that, this is part of the AI trade. I mean, something's got to power all of this, particularly when you look at the data centers. And one analyst pointed out to me that he thinks that the AI story is bringing sexy back when it comes to utilities. Is that what you're seeing, Kevin?
Yeah, I mean, you are seeing a little bit of a split between the traditional utility companies like a Duke Energy or a NextEra Energy, and also now seeing this difference between, let's say, Constellation Energy and Vistra and things of that nature here. And actually, Constellation Energy has moved up when it comes to the utility ETF or the XLU, which has been a very popular one. It's actually, I believe, the second or third holding at this point. So it completely kind of springboard to the top there. So yes, there's going to be the AI trade, but there's also the defensive component there if you are anticipating rate cuts coming down the pike here. Utilities that usually pay a little bit of a higher premium may be a little bit more attractive for investors that are looking for not only stock appreciation because of the secular nature of the industry, but also the dividend yield there. What's actually very interesting, we're looking at the S&P 500 in blue, and then looking at the tech versus the XLU or the utilities sector. So as that orange line goes up, that means tech is outperforming utilities. As that orange line goes down, that means utilities is outperforming tech. What's interesting here is that we are making new all-time highs for the S&P 500, but technically we haven't broken out of this ratio or this a flag pattern here when it comes to this ratio, which kind of just alludes to the fact that maybe we do have more to go when it comes to this concentration in the market. And I know that's not something that a lot of people are a fan of. I know that I'm not, but when you're looking at the components of the S&P 500 and how and what we really need to do to make new all-time highs, you'd like to see breadth, but you'd like to see tech and communication services still outperforming. So this ratio is just saying that we still have a potential breakout to the upside for this ratio right now, which would be conducive for the S&P 500 to move higher. Any type of further breakdown, or if this flag pattern continues to stay intact, or we see utilities outperforming tech, especially the traditional ones, that's when you get a little bit concerned that maybe the market will break down or roll over. That's not really being reflected right now. There's still a little bit more optimism that some of these other sectors like utilities, like materials that are smaller components of the S&P 500 can still see some positive investor flows because of their cheap valuation compared to their peers, other peers within the market here.
Okay, that's a quick look at the utilities space, certainly performing well there. But I'm just wondering what you're seeing as far as volatility, or perhaps a lack of, given, of course, all the information we got yesterday, which seems to be keeping a lid on things. But I've been, talking to a number of traders, even Scott Bauer pointing out this morning that that level seems to be screaming complacency. What are you seeing?
Yeah, I would agree with him. And actually, I'll bring up a seasonal chart on market on close here. But if you look at the seasonal nature of volatility, it actually starts to inch up. Actually, about a week ago, you would typically inch to the upside here throughout September. We're actually seeing a complete divergence of that with volatility kind of, still moving to the downside. It's the lowest VIX that we've seen all year. And we start to hit some pretty low levels. And once again, it's easier to re-rate higher than it is to re-rate lower. But this also does show that the market is really bullish when it comes to sentiment. And if you actually look at the VIX spread, there's probably still more room to go to the downside when it comes to the VIX or this complacency trade. But the downside probably is going to be, I would say, short-lived, at least for now. Just seeing a re-rating of volatility back to the upside doesn't automatically mean that the S&P 500 has to come down. It just means that at the end of the day, once it gets to a fairly low level, the VIX, you might start seeing institutions starting to layer into those out-of-the-money puts in order to kind of hedge some of their gains that they've had over the year here. What's also very interesting, Sam, is the volume that we saw yesterday. We actually saw the highest net positive volume in the S&P 500 total composite since May of this year. So that's also, once again, another bullish sign for this market. Hopefully we are able to continue to see that type of trend, but volume is now coming back in. To say that it's kind of lacking on the equity front is a little bit more of a misnomer at this point. We should start seeing it pick back up over the next couple of weeks. Hopefully that volatility stays stable and that leads to equity gains for the S&P 500 as well as the NASDAQ 100 as well, which is something that we also track on a daily basis.
Okay, awesome stuff. Thank you so much, Kevin Green, for getting us across all of that this morning.